So thanks again for joining us. We have a great webinar today. On the call, we have Erik Carlson as well. We are going to start the presentation right now. Just before we get started, a few introductions about ourselves. My name is Amit Urban. I'm here with KW Commercial in the Santa Clara office. I specialize in 1031 exchanges, and I work with clients who are looking to sell their rental or investment properties and build portfolios that meet their lifestyle and investment goals. Since 2017, I've worked and advised on $50 million of real estate transactions. I'm a licensed broker here in the state of California, and I'm also, I have a securities license Series 22 and 63, which allows me to provide some options that we will be discussing today in this webinar. What's not written on this presentation is that I grew up in a family of real estate professionals, and early on, I saw how smart investing helped them build wealth and live the life they've always dreamed of. Now, as a real estate professional for over 10 years, I work with investors and rental property owners to help them increase their income, guide them through the regulatory environment, and build portfolios that meet their lifestyle and investment goals. And in this webinar, we're going to be sharing some of the strategies we use with our clients to helpfully get you more listings. Erik Carlson, who's also on the call and is the director of the commercial team here in the Santa Clara office. Erik, would you like to say a few words about yourself?
Sure. Thanks everybody for joining today. Sorry for the black screen. I logged in and I was upside down on the video, so if you know how to fix that, let me know and I can get my video up there so you guys can take a look at me live. So, but from a background perspective, I've been involved in commercial real estate for over 20 years. I've concluded about $1 billion of transactions, including investment sales, joint ventures, development, leasing. So if you have a client that is involved in any one of those facets of commercial real estate and they need assistance, then let's work together and we can all mutually benefit from, again, our shared experiences and growing the KW brand here in the Bay Area.
Great, thank you, Erik. So today's agenda, our webinar is probably roughly about an hour, depending on the questions that are being answered. We will obviously stick around to have any discussions or answer any questions you may have. We also have Olivia on the line, who's going to be fielding the questions as they come in. So if you have any questions or something you don't understand or any comments, please just type them in the chat box, and she will be interrupting us as we proceed to address any questions you may have. At the end of the day, Erik and I, we do this day in and day out. We're here for you. We're here to support you and help you potentially get more listings. So just feel free to reach out or send a note in the chat box, and we'll address your questions. The agenda today, we went through introductions. We're going to talk about a concept called trapped equity, which is very prevalent in the Bay Area today. We're going to be talking about the tax problem that sellers face and how we can potentially solve that problem with a 1031 exchange and some of the strategies or options that sellers have to reinvest their proceeds that are available to them. And then we'll open up to question and answers. Before we get started, there are a few disclosures that we want to discuss. The first one is that returns are never guaranteed. We're going to be talking about investments here, but nothing is ever guaranteed. If anyone you're working with tells you there's a guaranteed return, turn around and run the other way, because there's risk involved with any type of investment, and that also includes real estate investing. We're going to be talking about the 1031 exchange, and we're going to be talking about which is in the tax code. Even though Erik and myself are well versed in the 1031 exchange and the process, we're not CPAs. So before advising any of your clients on what steps they need to take in order to conduct a 1031 exchange, please have them consult with a tax professional. Everyone's situation is different, and the impact of their decisions will affect them differently. And lastly, one of the solutions we're going to be talked about is available to accredited investors. And an accredited investor is someone who makes $200,000 a year as an individual, or single, or as a couple, they make $300,000 a year, or a net worth of $1 million excluding their prime residence. So with that, let's get started. Here's a trivia question for all. What does this number mean? Whoever can answer this question, I will treat you to a cup of coffee once shelter in place is over. What is 70,162? Let's give you 1 minute. If you guys can get this answer, I will treat you to a cup of coffee after shelter in place is over. Let's see if we have any answers come in. We'll see who's paying attention. You can also say, I don't know. The number of 1031 exchanges last year. Wilson, that's a good guess. Anyone else before we move on? The size of my waist after shelter in place. Thanks, Yvette, for the humor. No. So 70,162 is the number of absentee owners, single family homes here in Santa Clara County. I just want to highlight the opportunity that's available today in Santa Clara County for people that could potentially do a 1031 exchange, or you potentially help these clients with a 1031 exchange. So as Eric and I go through this presentation, we'd like that you guys would keep some stuff in the back of your mind. First of all, the opportunity. Over 70,000 single family homes that are absentee owners. That means that they're renting them out to a tenant. There are over 13,000 duplexes and almost 5,000 triplexes. So as you're thinking of your farm and your database, you should be asking yourself some of these questions, or ask yourself which landlords or which owners you're dealing with have owned the rental property for over 10 years, which owners have the difficulty managing their tenants, which landlords are concerned about issues such as rent control, which we're going to talk later about in this presentation. Not only is it rent control, the whole regulatory environment is changing here in California, and we'll discuss the impact that it may have on some of your clients. What are some of the issues that owners are having with tenants today? Are their tenants paying rent? You know, given this whole COVID-19 issue, some of the tenants are having some tough time paying rent. This impacts owners because they still have expenses that they need to pay for. Are some of the owners in your farm or some of your clients have really large repairs that are coming up that they just don't have the capital to do, to pay for? What owners are some owners looking for more income because of the current situation? They're not able to generate enough income to support their lifestyle. Have some of their clients have a lifestyle change? Are they going through divorce? Are they moving? Is there a health issue that's impacting them from, or preventing them from providing good management services to their tenants? Or even owners that are sitting on large parcels with underdeveloped lots, or any owner that you've talked to that said, if I could sell, where would I find a replacement property? So these are some of the questions or some of the scenarios that I would hope you can have in the back of your mind as we discuss or go through this webinar. So I have a poll for the audience. So from your experience, what is the average net cash flow on equity for income properties here in Silicon Valley? If you could type your answer in the chat box. Is it A, over 5%? Is it B, 3 to 4%? C, 0 to 2%? Is it negative cash flow, or E, I don't know? What do you guys think? Good to see you back on, Eric.
I figured it out.
All right. All right, no answers yet, but we have E question mark. Thank you, Wilson. So there is no right answer because every situation is different. But on average, what we're seeing, it also depends on the property type you have. Is it a single family home? Is it a 5-unit? Is it a commercial property? It varies from asset class to asset class. But what we've seen on average, we're seeing between around 2 to 3% net return on equity here in the Bay Area, which leads me to a concept that I'd like to discuss with the group. Is called trapped equity. So in this hypothetical example, imagine that there's an owner who bought a rental property back in 1995. He put a loan on it, 80% LTV, and over the years he's been paying off his mortgage and his property has been appreciating. Today, the property is worth $1.5 million, but his net income, that is his total income minus all expenses, he's getting $30,000, which puts a return on equity of about 2%. This is a scenario that's very, very common here in the Bay Area for many rental property owners. Let's take a look at a real life example. This is a property, you might know this property. This property sold back in October 2021, not October 2021, but October 21 as in October 21st for $1.6 million. If you go, we went on Craigslist and we found what the average rent for I believe it was a 3-bedroom, one bath would go, and it was about $4,000 a month. After your taxes, after insurance, after maintenance, the net income is a little over $2,000, which comes out about $24,800 a year. If you take that income and divide it by the price that you purchased the property, your year one return is 1.55%. And that's for someone who purchased the property today. However, hypothetically, if someone bought the property 25, 30 years ago and their tax basis was significantly lower and they were paying $5,000 a year compared to $20,000, their return on equity would still be 2.5%. So for many investors, the 2.5 is a very low number compared to what's available out there. Any questions on this concept of trapped equity before we move forward? All right, so let's go to the next question. Historically, have rents or housing prices grown faster in the United States? Is it A, rental rates, B, housing prices, or C, they're equal? What do you guys think? Just type your answer in the chat box. B, housing prices. B, Yvette, thank you. Wilson, thank you. Ding, ding, ding. You guys win a chicken dinner. That is correct. Historically, according to Zillow, since 2010, housing prices have appreciated almost double the rate rents have increased here in the Bay Area. Furthermore, if we look to the right side, the Bay Area rents, this is data provided from CoStar. They're forecasting that rents are going to increase between less than 2% over the next few years here in the Bay Area. So if you're a rental property owner looking for significantly more income out of your real estate, chances are you're not really going to realize that in the near future, just because rents aren't growing as fast as appreciation are, and also because there are the rent control is impacting how much rents could be increased here in the Bay Area, in California as a whole as well. So in addition to lower rent growth, rental property owners who are also dealing with the tenants, they're dealing with trash, they're dealing with toilets and taxes. If they want to sell, the taxes are super high. So what options are available to rental property owners to help them increase their income and potentially minimize their management responsibilities? And before I turn it over to Erik, there's a few things I would like to talk about before Erik jumps on and talks about 1031 exchanges and some of the replacement properties that are available. The regulatory environment here in California has changed a lot over the last few years. Late last year, it was voted the AB 1482 rent control issue pretty much put statewide rent control in California, which means 5% plus inflation. And this is applied to all units, all properties with 2 units and up and are 15 years and older. Do you guys remember Prop 10? Prop 10 was repealed a few years ago, but it's back on the ballot, and it's called Rental Affordability Act. And this is going to be on the ballot in 2020, and it's to repeal Costa-Hawkins, which would allow municipalities to apply rent control on single-family homes and condos as well. So there's a lot of pressure. There's a lot of pressure for more rent control or rent type or any type of initiative that will help tenants with their rental, with affordability when it comes to rent. Another thing that's on the ballot for November 2020 is called split roll. And split roll is, if it were to be passed, will allow the California to reassess commercial property worth $3 million or more. So if you have a multifamily property or a strip center or a industrial property that's worth $3 million or more, your property is going to be reassessed every 3 years at the market value. So imagine if your owner, your client, has had a property in their family for a few generations, the basis on that property is pretty low. If this were to pass and the property is worth $3 million or more, they may potentially have to be reassessed at today's market value. That's put a lot of pressure on the cash flow. So you have pressure squeezing the how much rents you can increase, and then you have upward pressure from the taxes increasing your expenses. So this is going to have a significant impact potentially on investment property owners and investors here in California. Another thing I want to address is the COVID-19 situation. I don't want to be political here, but I want to lay down the facts and the impact that it may have on rental property owners. As of today, you can't evict people for not paying any of their rents. And this is going to be delayed depending on the city and the jurisdiction you live in. But this could be 30 days, it could be 60 days once shelter in place is removed. So even if your tenants aren't able to pay the rents, you can't evict them and put someone else. You can only start the eviction process once shelter in place is removed. This could be 2 months, 3 months, 4 months. So if you're behind, if your tenant's behind 3 months, 4 months in rent, the chances of them paying you back, even if they don't have a job, I don't know if they're going to be able to pay back or not, but that's a huge sum for many individuals to pay all at once. So that could impact the owners, that could impact the cash flow of many rental property owners here in the Bay Area, because they have expenses, they have their mortgage payments, they have their property tax, they have their utility expenses. And as of now, I haven't heard of any policies or regulations to help rental properties in this place. So this may be added pressure to some of your clients that they may need a solution for. So this is something to be mindful when you're speaking with your clients in the next couple of weeks and months regarding their investment properties. So moving forward, I would like to pass the microphone to Erik, who's going to talk about the capital gains tax issue, 1031 exchange, and some of the replacement options available to your clients.
Great. So as Amit had just mentioned, talking with your clients and trying to get a better understanding of, what their pain points are, and it could be, one, or it could be many of those items that we just discussed. One of the big ones is, okay, if I sell my property now and I have to pay, a significant portion of capital gains, I don't want to do that. So a 1031 exchange does defer, and that is a key term. So as we were talking about for the capital gain, so again, the key terms there is just the deferment of the taxes, and then the second one is, again, the big portion of that is the depreciation recapture upon a sale. So when we have conversations with clients, they always express a few concerns. Taxes is one, timeline, finding replacement properties, qualifying for new loans, and tax consequences, and some of them say, I don't know. So what, in your guys' experience, what are you seeing as the client's biggest concern regarding their 1031 process? And if you guys, if we do have the chat box, you can plug in your answer there and see what everybody's seeing right now through their conversations.
Seeing 2 slides. Oh, whoops. Hold on.
So Maddie, uncertainty if they will find the right property within the time frame. That's always it's always a common one. What do we do with our reinvestment proceeds if we were to sell? And everybody has a different perspective as to what their circumstances are, what their concerns are going to be. So, there's no one right answer. You are going to hear a lot of these, and having a response. It's analysis paralysis. Just not being able to make a decision, and hopefully, listening to you as to the guidance, as to the options that we'll talk about later on in the presentation. So as far as the time frame, not to get into a lot of the details regarding the 1031 process, there is a time period that they need to abide by. There is identification within the first 45 days from close of escrow. It's not 45 days from the time that they put the property in escrow. It is 45 days from the time when the sale is completed and the proceeds are then transferred to a qualified intermediary, or also known as a QI. If you don't know what that is, please ask. And then from those 45 days to identify 3 properties, they need to close then within 180 days to complete the 1031 process. So as far as the QI goes, just a quick background on that. That is a third-party service that needs to be involved to complete and to abide by a 1031 exchange. In the event that you take constructive receipt of your proceeds, your 1031 is null and void, and you'll have to pay property taxes. So if you have a client that closed on the property and they have a check in their hand and they say, well, I want to do a 1031, unfortunately, that's too late. So you need to have the conversations with your clients, prior to entering into an agreement to sale, or have some sort of exit strategy before you list with them. And so we can get involved, or you can get a QI involved through that process. All right, so other challenges that we're finding is just finding the correct replacement property. Prices right now, they were at their peak. There's probably been some price adjustment, but again, sellers and buyers, they always have that price gap as to expectations. As we alluded to earlier on in the presentation, single-family home investment opportunities, they don't yield the biggest return. It is common. Most 1031 exchanges are from residential property, being single-family homes up to 4plexes. And then again, the 45-day time frame can be a concern for those individuals. Finding that replacement property, sometimes they can be taken advantage of in negotiations if the other party is aware that you are a 1031 buyer. And so just be mindful of having those conversations with, if there's another broker involved, try to keep that information in there. Again, you can identify 3 properties, but again, sometimes, things happen, and, you're going to get to a backup of a backup. And so that's something that the DST would be a good solution for, which Amit will talk about here in just a brief moment. And some challenges that we're seeing is that some owners are getting a little bit older. They're looking for maybe a little less, management intensive. So, trying to find those here in the Bay Area, whether it's a single tenant, triple net, or alternatives, that can be difficult given that the prices, they do kind of price out, for certain type of assets. So as we talked about, some additional potential replacement properties that have minimal management hassles. These are just common ones that we've experienced with clients. There are others, but we'll just concentrate on these today. Single family rentals is a very common one for 1031 purchasers. And again, whether it's in-state, out-of-state, single tenant net lease properties, and then Delaware statutory trusts. So those are very common ones that we are submitting to our clients to try to get them enticed into putting their trapped equity to better use. Now, trade-offs of wholly owned out-of-state residential properties, such as the single-family homes or the smaller apartments. So here are just some pros and cons. Yields are typically higher outside of California. I've seen a lot of interest in going to Nevada, Texas. So those are some out-of-state properties, out of states that that we have seen some interest in exploring, exiting here. So you do have direct control. Some states are going to be more landlord friendly. The political nature of California has motivated some to finally exit. Again, subject to finding a solid replacement property outside the Bay, outside of California. So that leads into some of the cons. Out-of-state properties, they're a little bit more difficult to find. You're going to have to find or hire a broker in a local community to really scour the geographical areas to make sure that whatever you're purchasing is a good property. If you're going to be doing single-family homes, sometimes they can be management intensive. You can hire a property manager to eliminate some of that, but you are still going to have the management costs of replacements, hot water heaters. You just won't get the phone calls, but you do have the expenses. Travel to the property, that could be a pro or con depending on where the investment is. Maybe Hawaii is your destination, and you can write off that expense to Hawaii. So this next one here is qualifying for a loan. That is one that some people don't take into consideration. So for the lender market today, this may be more of an issue for qualifying. If the asset doesn't underwrite to 100%, and they look at your global debt coverage ratio or your global debt coverage cash flow, then and if you're a retiree, that's going to be difficult. So just something to be mindful of. And again, if you're going to be going into a single tenant net lease, or out-of-state residential, if you're going to be all cash, sometimes they have a higher cash investment that's going to be required. And then, as I talked about, sometimes the owner is going to be responsible for all the expenses and the liabilities. Single tenant net lease investments, typically you're going to have these purpose-built facilities that you see occupied by fitness, quick serve restaurants, pharmacies. These are typically occupied by a single tenant, long leases, 10 years or greater, with rent increases. And again, single tenant net lease properties, this is where the tenant is responsible for 100% of the maintenance and repairs at the property level. That includes, again, paying for property taxes, insurance, and maintenance, but over and beyond that, you're going to get into the lease types, which we'll talk about on the next slide. So some pros for single tenant net lease properties. You do own the property outright. You do have a long-term lease with the tenant. So normally what we'd like to see with our clients is a lease term of 12 to 15 years. You do get better financing term with longer lease terms. Again, minimal management responsibilities, given that the tenant is responsible for all expenses and repairs and maintenance at the property, and the lease is usually guaranteed by a corporate entity. Some cases, you get into a franchise situation. Just make sure that your franchisee or the operator of the property is has a well-suited balance sheet to make sure that that rental income stream is going to be there for the period of the 10 to 15 year lease term. Some of the cons, the not so good things about the single tenant net lease properties is that there are go dark provisions in the event that the retailer shuts down operations and finds it's cheaper not to operate at a property, but continues to pay rent. Why does that matter? If they pay rent, well, again, if they go dark, what's going to happen after your lease term is completed. You're going to have an empty building. And so the value of an empty building is going to be sufficiently less than the value if they were in there paying rent. We have some clients that invested into DaVita, dialysis investments here in California. They got into a game of chicken with the operator, and that's going to be something that you're going to have to take in consideration. Can you renew the tenant at the same terms that they're paying for right now? And if they don't, then you're going to have renewal costs. So you need to be mindful of kind of what your exit game is, and that exit game can also take in consideration, okay, what is the value of my property as each year that I own this thing? Because again, the value of these single tenant triple net lease properties is because of the rental income stream that you're going to be realizing over that 15-year period or 12-year period. So each year that you collect that rent, the value of your property goes down. Sometimes you need to qualify for a loan. That's not 100% applicable to all transactions, but that is something that you need to be mindful of. I think more so that we're seeing right now is that the retail industry is seeing a change. What we call the Amazon effect is disrupting some non-service related traditional retail centers. Even more so now that we see with COVID-19 that some of those mom and pop restaurants, they are shut down. And so you are seeing an impact of non-collection of rents during that time period. Next slide. Oh,
All right.
heading back to Amit to talk about some of the DSTs that eliminates some of the cons that we just talked about in some of those other asset classes.
Thanks, Erik. Maddie, I see, had put a question in the chat box. So she asked if we put those states because they have the best appreciation for single family rentals. The reason we put those states is just because most of the clients we're working with are looking for income. These states don't have anything near the appreciation we have here in the Bay Area, but they do have better cash flow than what we're experiencing here in the Bay Area currently. And I'd also like to add that a lot of the essential retailers, the Walgreens, the dollar stores, the Tractor Supply stores, they're actually doing very well right now in the COVID-19 pandemic, just because they are essential businesses. So it really depends when you're looking at triple net properties for your client. It's important to take into consideration what category they fall in. Like Erik mentioned, restaurants versus essential tenants. That will obviously impact and change the future of each of these tenants. All right, so moving on, I would like to discuss something that's become very popular since 2004, which is the Delaware Statutory Trust. Back in 2004, the IRS issued a revenue ruling 2004-86, which qualified the DST, the Delaware Statutory Trust, as like-kind property for 1031 exchanges. And what the Delaware Statutory Trust is fractional ownership in larger institutional quality real estate, such as large multifamily projects, office building, shopping centers, a portfolio of triple net retail or medical office buildings, and these DSTs come in all flavors. Like I mentioned, there's multifamily DSTs, there's medical office DSTs, self-storage DSTs, which is really nice because it provides investors the opportunity to invest in some of these institutional quality type of assets that are professionally managed. The minimums for the DSTs are pretty low, between $25,000 and $100,000. So investors that are looking to exchange larger amounts, maybe $1 million or so, they can build a nice portfolio for themselves and diversify across asset class, geography, and sponsors. The nice thing, another benefit of the DSTs is that these are already cash flowing properties. They are already producing between 5 to 6% to the investor that's going to be 1031 exchanging into these type of properties. And because they're already existing cash flowing properties, you can usually close between 3 to 5 days. You don't need to qualify for a loan, and you don't need to manage any of the tenants' trash or toilets. And the sales fees are paid by the sponsor. So whatever the investor invests, whether it's $1 million, they're going to be getting 5 to 6% on their equity that they invested. So that's $50,000 to $60,000 a year of net income. So like I mentioned, DSTs come in all flavors. Here we have a chart that shows the breakdown. The most popular are multifamily DSTs, and I think one of the reasons is because a lot of the first of all, at the end of the day, many people still need a roof over their head, regardless of the cycle we're in. And secondly, many investors made their money off residential investment properties, and they feel very comfortable in the residential space. And this is not Johnny. This is not an investment product that's just came out a few years ago. It's been around since 2004, and in 2019, they raised almost 3.5 billion in equity for the Delaware Statutory Trust, which is a 40% year-on-year increase. There are sponsors that put these deals together. They go out, find the property, put the loan on the property, put the management team in place, and manage the whole program for their investors. And currently, there are about 38 sponsors. And the average return year one's about almost 5.5%. This industry has because it's attracted so much equity and capital, there are more players coming into this space. So it's very important that you work with someone who understands the DST space and the sponsors and their track record. There are huge institutional companies such as JLL Capital, Cantor Fitzgerald. These are big firms based in New York that are entering this space because this industry has attracted so much equity. Some of the fee restrictions that the Delaware Statutory Trust has. This is a passive investment, so the trustee makes all the major property decisions. Similar to investing in a stock, whether it's Apple, Facebook, Google, you're investing in the management team because they're going to be making all the decisions for their investors. You as a shareholder don't, unless you have a certain amount, don't have any say in the day-to-day management. However, you're betting your chips on a horse in the management team. So this is completely passive investment. Secondly, the trustee and the sponsor is the sole borrower, which is also a positive thing because you don't have to qualify for a loan, and majority of the loans are non-recourse. So if the property were to default, the banks or any institutions cannot go after the investors in that DST program. And because the loans are already in place, you also don't have to qualify, which Erik alluded to in a previous slide. One of the challenges of finding a replacement property is qualifying for the loan. It's not just qualifying for the property, but also having the individual qualify. And if the individual is no longer working and has no income, there will be some challenges when it comes to qualifying for that loan. Properties must be fully capitalized upfront, no capital calls. A lot of these properties, they have reserves in place. If they foresee that they need to change the roof or redo the parking lot 3 or 4 years down the road, they cannot go back to the investors and ask for more money. So they have to forecast and put this capital in reserves. So which means that when you invest your initial investment, whether it's $500, $1 million, that's all you're going to be responsible for. You're not going to have to take any more money out of pocket in order for any additional capital expenditures. These are long-term investments, typically 5 to 10 years. Historically, the average hold for the multifamily properties has been about 4 years, I want to say, but depending on the asset class, whether it's a triple net lease portfolio, self-storage, senior living, the holding period is going to vary. Just because they hold for 10 years doesn't mean they can't sell sooner. Many times, if an offer comes in before the 10-year holding period that meets their investment goals, they're going to notify the investors, let them know, hey, an offer came in, we're meeting our business plan targets, and we're going to sell in advance. And at that point, the investor has the opportunity to do another 1031 exchange. They can either continue in the Delaware Statutory Trust space product, or they can go back into traditional real estate, whether it's a single family home or an apartment building, etc. The DSTs are considered securities. So if your client is interested in doing the DST, then you have to partner with a financial advisor like myself, and we can help you and your client identify and reinvest their proceeds into a Delaware Statutory Trust. And lastly, target returns are not guaranteed, like with any investment. the things can change. Rent payments. It's an update from many of the multifamily DSTs is that April payments were good, May payments are looking good, but who knows what June and July will look like. And if we continue in this environment, there may be some, the distributions may be lowered by a little bit just because the sponsors aren't going to be able to collect all the rents.
Hey, Amit.
Yeah.
Really quickly, Maddie has a question. She asks, who is your preferred sponsor?
There are many sponsors out there. I like Inland a lot. I like Pasco. I like Starboard. But you have to look. You can't just look at the sponsor. You have to look at the project, that the DST that they're putting together as well, the geography, their business plan, etc. So even though I'm affiliated with a broker dealer called Concord Investments, and they are like the KW for the securities world. But a lot of the DST programs that many of these top sponsors that I like working with come out, they are not all approved based on based on where the property is located, the geography it's located, their business plan, etc. For example, Inland in the past would put out hotel DSTs, and Concord was very reluctant to approve those. So it really depends on the project and the DST program. And now I'm kind of glad that, given what's going on with COVID-19, I'm kind of glad that the hotel DSTs have not been approved for the most part. I hope that answers your question. But if you'd like to go into further detail on any specific sponsor, happy to sit down with you and go through the pros and cons of specific programs as well. All right, so some of the trade-offs of the DST properties, the pros are it's suitable for 1031 exchanges. These are minimal management responsibilities, which is perfect for owners seeking hassle-free management. Pros they offer many times, because you're going to be 1031 exchanging to a property that has a loan in place, you're going to be getting additional real estate, which you can depreciate and shelter some of that income. No loan responsibilities for investors. These are typically institutional quality properties, 300-unit apartment buildings, professionally managed shopping centers, and self-storage properties, and senior living properties, etc. The minimums are low, which provide diversification potential. You can diversify across asset class, sponsor, geography, so you don't have all your eggs in one basket at any given point. And the nice thing is that these are readily available at any given time. You have about 15 DST programs that are available. So if your clients are doing a 1031 exchange and they need some backup options, the DST is a good solution for a backup. It's a form of, I guess, of quote unquote insurance in case your first option falls through. Some of the cons are the trustee makes all the decision, but they do have a fiduciary responsibility to their investors. So the investors are passive in this investment. The typical holding period is 5 to 10 years, and you can't tell the sponsor when and where to sell the property and to whom to sell the property and what kind of improvements to do the property. This is a wholly passive type of investment. It's similar to other real estate. Returns are not guaranteed, and the DST is the option that's only available to accredited investors. So when to consider a DST? If your clients are looking to save taxes by doing a 1031 exchange and reinvest their proceeds to help take that money they would have paid to Uncle Sam to help them generate more income and more wealth. They're looking for 1031 replacement properties, and they don't have to. They don't want to spend 2-3 weeks looking for options. That's a DST may be a good option. I just spoke with someone yesterday that is in the middle of a 1031 or in the middle of selling their property, and I asked them if they're doing a 1031 exchange, and they said no. And the reason they said no was because they don't want to spend the time looking for replacement properties. So this may be a good option. This is for a good option for owners who are seeking more income with less management responsibilities, for owners who can't qualify for a loan, If you're looking to diversify your portfolio with low minimums, the DSTs are a good option. So who should invest in a DST? In the beginning of the webinar, we talked about some potential profiles of your clients that may potentially be interested to help you get that listing, and rental properties that rental property owners with trapped equity that they're maybe getting 2 or 3% and potentially be getting 4 and 5% to increase their income, retirees who are looking for less management responsibilities, or owners who are just tired of the responsibilities associated with managing tenants, or any type of ownership group that is dealing with divorce, health, or any kind of lifestyle change. So again, I just want to recap the opportunity that's available for realtors. There are 70,000 absentee owners, single-family residents. These are properties that are currently being rented out, and this is a good time for owners who are struggling to manage their properties. Are looking for additional income or are going through some significant life transition. This may be a good option to talk to them about doing a 1031 exchange and helping them. You guys can get the sale and helping them build a portfolio that meets their investment and lifestyle goals. And many times you're facing with owners who have rental properties and they say, I'd sell if I could find a replacement property. So I think the options we discussed here today, whether it's properties out of state, single tenant net lease properties, or the DST, should at least get the conversation started with your clients and hopefully get you a listing, and hopefully you can improve your client's situation and increase their income.
Yeah, I would say, just to add on a little bit there, Amit, I mean, as far as, your listing presentations with your clients, right, try to use this as a differentiator, if they're meeting with different brokerage companies, right? So you at KW have, this opportunity that you can use as something to kind of, say, hey, look, we can help you from start to finish with your investment opportunity. Or if they're looking for a way to minimize their taxes by, taking their single family home that they live in and converting it into a rental property, and then where they go from here. I mean, these are all things that we can help their clients and help you understand kind of what their options are when you have those meetings and those discussions with your clients.
At the end of the day, thanks, Eric. At the end of the day, people sell because there's an opportunity or there's a pain point in their portfolio or with their specific rental property. And if you can identify the opportunity, which is potentially more income, less management responsibility, or a pain point, I think there's a good case for talking about 1031 exchanges as a way to help you get that listing and improve your client's situation. So like Eric mentioned, feel free to use this as a resource. We do these 1031 exchanges day in and day out. We can do analysis for you and your clients just to show the potential income they could be generating through a 1031 exchange, whether it's a single family home or a small apartment building out of state, or a single tenant net lease property, or even the Delaware Statutory Trust. So feel free to use us as a resource. We're more than happy to jump on a call or a joint presentation and talk with you and your client, about some of the options that are available to you. So I wanted to thank everyone for their time. I